Hi, this is Jim Baldonado from the Home Agency, and with me today is Arlyn Rieker. And today what we want to talk about is LRP, Livestock Risk Protection. Arlyn Rieker is definitely our LRP expert, and what LRP does, it's a risk management tool for all cattle producers out there. And with that, Arlyn, please introduce yourself.
Thank you, Jim. Just a little history about myself. I was born and raised in Eustis, Nebraska, and born on a family farm, and went to UNL, graduated in 1984 with an Ag Econ degree, then came back to the family farm and cattle operation for about 15 years, managed my own cattle operation and farm, and then shortly thereafter, I decided to join the home agency and come on with, quote, a second full-time job.
So tell us a little bit, Arlyn, when did LRP become available?
Basically started in the early 2000s. It was really kind of a primitive product. It was basically designed to protect for the decline in the cattle markets. And when it first started, the subsidy level was 13%, and we could only go up to about 95% coverage level. And then as the policy evolved, the subsidy went from 13 to 35% in the most recent years, and now we can insure up to 100% coverage level.
I can remember, when you came to work for us almost 20 years ago, I believe. I think you told me the other day one of the first tasks that I offered you to do was be our LRP expert.
I remember that day. It was, I'd only worked there about 10 days to 2 weeks, and you came back to my office and you just said, you came to our agency with a farming background, you understand livestock, no pressure, but I would like you to become our LRP expert. And so here we have evolved into that 16, 18 years later, and I enjoyed it a lot.
And you do a fantastic job, as well as teaching our other agents as well how to do it. We were talking earlier about the subsidy and how we get such a larger subsidy, and that is a big one. What else has changed over the years?
Well, when the RMA made the changes a couple years ago by increasing the subsidy up to 35%, they also made a huge change that in prior years the producer had to pay for the policy at the time we wrote the coverage. Now they do not have to pay for it until the policy or the endorsement actually expires. So the producers aren't outlaying any money up front like they are put.
And that's similar to how crop insurance is. You buy the policy and then you don't pay for it until after harvest. And that's somewhat how LRP does, is that, if you have a claim, it's actually your premium's taken out of your claim. And of course, if you don't have a claim, which you don't want to have a claim, you just pay for it at the end. The policy has definitely evolved over time and has given producers a lot of nice options. Can you tell us how the policy works? And is this a tedious process? Because, a lot of producers, we don't like to spend a lot of time on paperwork.
Jim, it's a very, very simple product. Basically, we contact the producer, they contact us, we get the application process completed, and then we just find out the type of cattle, the time that they're going to sell their cattle, and kind of the coverage levels that they want. And then we just, the quotes are available at 3:30 every afternoon that the Chicago Mercantile Exchange is trading, and they're available till 9 a.m. the following morning. So basically what I do is I find out what type of cattle you want for coverage and the time frame you're going to normally sell them. I either text you or call you with a quote after about 3:30 in the afternoon, and then you have that evening to go back and spend with your spouse or your business partner or whatever to make the decision by 9 a.m. the following morning. And then if you decide to write the coverage, most of it I do, like last night, I did some coverage at 10 o'clock at night, and the producer just calls me, lets me know that, hey, we're ready to write the coverage. I go ahead and key it, and then we're ready to go. And then you just wait until that policy expires. And if your coverage price is higher than the ending price, you collect a loss.
And Arlyn, we've been around this together for a long time, and I know how often that phone rings, even to me once in a while, but to you all the time, because, LRP is not for every agent. A lot of agents, they have so-called banker's hours. You cannot write LRP during the day. You have to write it late in the afternoon or at night or early in the morning. And I know you're in there early at 7 o'clock, you're writing LRP, and that's where you have built such a big book of LRP business to go along with, if you're writing my LRP, you might as well have my crop insurance as well. And like I said, you do a tremendous job with that.
Thank you. It's became a kind of a foothold for us as the agency, because people know now that our phone is available at 7, 8, 9 o'clock at night, and then also, yes, we are in the office early in the morning, but and the thing that's been really exciting for me is we've grown into about 10 different states or more on the availability of being able to write the LRP, so that our coverage is broadening, and that's encouraging to me.
Yes, it is. Arlyn, you've talked about coverage prices and ending prices. How are these numbers calculated?
The coverage prices, rates, and ending values are all factored off of the futures. And then the ending price is actually figured off of the cash index. So basically the product is, your coverage prices are based off of the futures, and it is settled to the cash.
Okay.
And then there are price adjustment factors that are factored for steers and heifers. So we basically have 3 different categories of coverage. We have the the weight ones, which is 599 pounds or less. We have weight twos, which is 600 to 900 pounds, and then we have fed cattle. And primarily we write the feeder cattle contracts more than we do the fed cattle, but we are starting to get into the fed cattle quite a bit more. And on the fed cattle, we can insure 1,000 to 1,400 pounds. And using those price adjustment factors, everything is based off the steers, and then either for a lightweight or the heifers, we just apply price adjustment factors to those. And those price adjustment factors are also applied to the ending prices also.
I see. It seems funny to refer to livestock as a type. Most of the time it's breed, but now unborns? This is a new type, correct?
That is correct. A couple years ago when RMA made all these changes with a 35% subsidy and being paid at the end of the contract period, or not paying the premium until the end of the contract period, they came out with a type of what they call unborns. In prior years, if you were calving, you could not write coverage on the animals until the calf was actually born. Now what they've done is they've blended the steer weight one and the heifer weight one price, and they've come up with what they call the type of unborns. So now, as long as you have ownership of a pregnant animal, whether it's a heifer or cow, you can actually write coverage on that unborn calf, just like you could waiting for the calf to be born to apply the steer and heifer weight one.
And that's been a big deal over the last 6 months that I've listened to you guys sell, because a lot of these cattle or calves that we have been writing have been on unborn calves.
Yeah, it's really nice because we met with a couple producers the other evening, and their question was, well, I have 100 cows, I have 25 calves on the ground, what do we do? So we have the availability of writing, say, the steer weight one on the animals that are born, and at that same time, we could write the remaining 75 head as an unborn, and they would have their full 100 head covered.
And the nice thing about that is that if they've got the price that they want, moving forward, they don't have to wait until they're born and have the fear of the market dropping.
That is correct. And we've seen that in years past, that if we, early in the spring, we'll have a good coverage price, and if we wait until those calves are born, we do have that market drop sometimes, and then their coverage price would be lower.
Correct. Are there certain times of the year, and are there certain times of the year that the policy is available? And when would a producer want to get in touch with us for coverage?
The nice thing about this policy, Jim, is unlike crop insurance where we have to have the coverage in place by March 15th or September 30th, LRP is very flexible. We can write coverages, we can write a policy or coverage any day throughout the year as long as the futures are trading.
One question that I know of has been asked before that comes to mind is that a producer will ask, does it make any difference what I actually sell my animal for at the sale barn?
No, it doesn't. The nice thing about the policy is you just give us an estimated weight, the estimated time that you're going to sell the livestock, and let's say you insure an 850 pounder for November 1st. If you sell that animal if you sell that animal at 800 pounds, that has no bearing on the policy. You've insured an 850 pounder, so that is what you're going to pay your premium off of, and that is what you would be paid to loss if you have the loss. The nice thing about this policy now, another change that we didn't speak about is the 30 to 60 day window. Going back to the 850 pounder being sold on November 1st, in prior years, you could not sell that animal more than 30 days before November 1st. Currently, they have increased that up to 60 days. So that gives the producer a greater flexibility in being able to sell that animal if they want to sell it, up to 60 days before the contract expires.
Well, and with the dry conditions that we have, that's very important because they may be running out of grass, they may be running out of feed, and maybe they haven't harvested any corn. And if they need to, they can sell those, like you said, 60 days out and still collect a claim if they have one, on November 1st.
That is correct. And the really nice thing about this is for guys that are backgrounding, say if they have an August timeframe expiration date, and we do hit the drought situation like you spoke of, that gives them the flexibility of those extra 30 days to be able to sell those prior with no penalty for the policy.
Correct. I know the answer to this, but I know LRP is not a mortality policy.
That is correct. It's LRP is what they call a single peril policy. It is for the protection for a decline in price only. The question that we receive on mortality is if an animal does die and you contact the agent, if you have a revenue loss on those animals, you will still collect that revenue loss, but we will not pay you for the value of that animal at the time that it dies. So it is not a mortality policy, just a revenue policy.
I think, I'm just trying to think, I know there's stories out there that people do business with you because they know you don't have banker's hours. You're going to take their call at 10 o'clock at night, and we preach that. We encourage, and I don't know if we want to talk about this on the podcast, but we encourage people to get their application submitted so we can get it processed. So that way at 11 o'clock at night when someone calls you and say, hey, I really need to pull the trigger on this. I've got 220 head of steers and 40 head of heifers or whatever the numbers are. We can get that process because you can't just do it at 5 till 9 the next morning. So I think those are things that people need to know, that you or some of your staff that write LRP, we write it at, late at night and early in the morning because that's when it has to be written.
A lot of agents that just, or we'll have producers that will call their local agent and they'll run a LRP quote currently on that day. But what I do is I actually run the quote daily so I can follow and track what the coverage prices and rates are doing. And I think that gives our producers an advantage. And then also I come from the risk management side because I still do farm. I don't have cattle anymore. But it puts it puts it in perspective for me what I'm actually trying to do with the producers to give them the proper risk management tool. And I do remember back, this was 10 years ago or so, You were down at a trade center or trade show down in Manhattan, and you called me about 10 o'clock or 8 o'clock in the evening and wanted to know what I was doing. And I said, well, I'm writing LRP. And you said, why are you doing so much? And I said, well, the premium has dropped a little bit and the coverage price went up quite a bit. So I really felt there was an advantage to our producers to put the coverage on because their cost saving, their out-of-pocket cost was so much less than it was the day before. So that evening, you and another agent started calling producers, and we wrote coverage till about midnight that night on quite a few producers. And to me, that kind of put us towards the top, because I felt that we went above and beyond, and producers, when these policies expired, appreciated that we were calling them at 10 o'clock at night and letting them know what was going on. And I'm not saying, I am saying we put more time into it than I feel other agents do.
And there's no doubt about that. And I've got a story as well. I remember getting a call about 4:30, 4:45 on a Friday afternoon from a producer that had been talking to us but felt that he should do business locally. But he waited till after 4 o'clock when the agency closed and he couldn't get a hold of his agent. So then he called us because he knew that we would take his call and we would write his LRP. So we are different than most. We've got to be hands-on. We've got to service those policies, and we got to take care of these producers around the clock, because we both know if it wasn't for the ranchers and the farmers that we have out there, we wouldn't have our business in Elwood or Eustis, Nebraska.
Yeah. And one thing that I really feel this year and last year also is the coverage prices are up there where we've never seen them before. Along with that, the producers' inputs have increased substantially also. So we really need to be out there in front of the producers with the numbers, trying to do protect their bottom line on their cattle, because the LRP is pretty much one of the most viable options for it.
And I know also, banks where they don't know a lot about LRP, it's kind of strange to me that they will make it mandatory that you carry multi-peril crop insurance in most cases to cover their loan, and in some cases hail. But, there could be a guy out there with 500 head of cow-calf operation, and they don't seem to be too worried about coverage on those. But when you turn around and go to the bank and say, hey, I have LRP on my cattle, that banker likes that.
Well, and one of the things that I've seen quite a bit in the past is, or just most recently, but producers that are going to sell barns or having an order buyer go in and try to buy their cattle, they're calling me that morning and they're saying, okay, what were the coverage prices last night for, say, November 1st? And they're trying to get a forecast of what they feel the market is going to do and buy the cattle according to that, so they can apply that to their break even. And then that evening, they'll just call me and say, we bought 50 head. Let's put coverage on for that time frame. And so we can kind of give them of what it's done the day before, so they can go and plan on what they're going to buy at the sale barn that day. A lot of our young producers that we are dealing with right now, they are getting like FSA loans or bank loans, and they're laying out a lot of money for the calves. And so we have what we call a confirmation page that we print off when we key the coverage, and we supply that to the bankers just for collateral, basically, to verify that the producer does have a price floor on those cattle.
Something that we really haven't touched on is trying to compare LRP to a put. Now, it's a little more complicated than that, but people really need to look into what those differences are, because LRP is very competitive.
It's very, very competitive. Once they set that 35% subsidy, that just put us in a whole different ballgame with a put. And then secondly, you do not have to pay that premium until your policy expires. So those two advantages right there, there is no money outlaid up front, and the producer premium is substantially less than it was initially. And then the very flexible part about the LRP is you can insure anywhere between 1,000 and 6,000 head per endorsement and up to 12,000 head per calendar year. And so that gives a guy a lot of options as to, if I only have 25 head or if that's all I want to do, I can write 25 head and I don't have to go out and buy the whole cost of a put.
And I can remember years past, Arlyn, a father educating his son on the son's calves for 4-H. I think if I recall, he would buy LRP on one head, and then he'd have a calf in a couple weeks, and he'd buy LRP in another head on another one. So it's kind of neat to have the father that understands LRP trying to teach his son how it works, and the son actually writing a policy, on one head.
Yeah, the actual situation, I rented some pasture to a young kid with 7 cows. And every year we would write 3 steers and 4 heifers or vice versa. And it just gave that kid the psychological confidence that he had a price floor out there, that he was actually going to, not lose money on those calves. And his 7 head were just as important as another guy's 400 head.
Sure.
Because his break even was, he needed to make money on those 7 head just as much as the guy did on 200 or 300 head.
Correct.
Coming from a farm background, I think has led me into kind of the fun part of LRP is I'm not scared of the hours. It gives me a farmer's perspective on what the producer is actually doing. And so from my standpoint is I try to find the best risk management tool for that producer. Sometimes I can't. But if we keep looking at options and more options, the LRP eventually we will be able to find a coverage rate that suits that gentleman's coverage, price, and premium. And coming from the farm, I think it's been a great instrumental tool for me to understand where that actual client that is calling in and what he's trying to achieve with what he's doing. And then the part that we take, or myself and my co-agents, we'll take a call at 10 o'clock at night, and if we need to write the coverage, we just go ahead and we'd get it done. What I want to achieve with my clients is just the trust that they know that I'm always out there, and I'm trying to find them the best risk management tool for them. And like I said, at sometimes we can't find that option, but if it's I just want to make sure that we're taking care of the producer as well as we can. And one of the things that I have learned through this business, when I was farming, I didn't have to listen a lot because I didn't talk to too many people. But as I became a crop insurance agent and an LRP agent, I have learned to listen to the producer, find out what his desired risk are. I've tried to listen to the producer and match his coverage to the risks that he feels is most important to him.
And I think it shows because when you get a call somewhere in central Kansas or wherever, when you go talk to that person, I can almost guarantee you within the next 6 months, you're going to have another producer near him, or 3 or 4 or 5, call you, whether it's on crop insurance or LRP, because the producer that called you, he had a great experience with you and he knows that you understand what you're talking about. And so that coffee shop talk does work. And so I've seen it time after time that you'll go to this area and then pretty soon you're going to that area and now you're spending all day there because you're not just seeing one person, you're seeing 4 or 5 and then pretty soon 3 years later you're seeing 15. But Arlyn does a great job at that. It's not really cross-selling. It's just knowing his stuff and having his insureds talk about him. And that's what gains us a lot of business.
Well, and that's the fun part about it. I actually tomorrow am going to a person that I normally work with his business, and I'm going to meet his friend as a referral. And that's the best part about this. I'm getting to know more people, more different situations, and it's just great when we can sit around their kitchen table and discuss what their risks are and get to know their wife, their kids, etc. And that makes this business a whole lot more fun.
You know, Arlyn, like I said in the past, you do a great job with LRP. You do a great job of teaching our staff over the last 15 to 20 years. And so people that want to really understand LRP and how it works, please give the home agency a call. Ask for Arlyn or any of our agents that are associated with the home agency.